Hello, everyone, and welcome back to First Command's Market and Economic Update, where, like every quarter, we're going to dive into what's been driving markets and, more importantly, what's top of mind as we think about what's coming next. I'm your host, Matt Connor, and I'm joined, as always, by our Deputy CIO, Matt Wiley, and our Head Investment Strategist, Dan Murphy. So the last few months were obviously dominated by the Iran conflict, but there were a few other major stories as well. We had the largest IPO in history with SpaceX, more big tech developments, and, of course, a brand new Fed chairman who seems to have his sights set on changing a lot more than just a name placard on the office door. So let's dive in. Mr. Wiley, how are the markets and economy holding up despite all the headline drama we've been living through?
Thanks, Mr. Connor. And that's actually a great setup for us to discuss the details of last quarter because the market's return masked a lot of drama beneath the surface. For anyone not following closely, you may assume that the S&P 500's return of about 15% implied a very smooth path, particularly with the index closing near another record high just a hair below 7,500 on the way into July. But in reality, as we left March, investors were still grappling with a then new war against Iran and all the oil price volatility that came along with it. But of course, the very first day of April really set the tone for markets after President Trump announced through social media that Iran's president had asked the U.S. for a ceasefire. And while the path to the ultimate memorandum of understanding that was just signed in late June was not linear, the market was able to start pricing in an eventual end to the armed conflict, and that really allowed investors to start focusing instead on the market's fundamentals. And on that note, the fundamentals remained really strong. S&P 500 earnings, for example, started rolling in materially better than expected and ultimately capped off another mid to high 20-ish% annual growth rate on the back of record high profit margins. The more encouraging part of this story, though, is that it wasn't just those mega cap US tech companies driving earnings growth. It was really coming from emerging markets, from small caps, from more cyclical sectors like industrials and financials, and even moving down the broader AI supply chain into industries such as semiconductors, all of which are actually still leading the equity markets higher year to date. This set the stage, as you mentioned, for a really hot IPO market as well, which included the largest ever in terms of capital raised by Elon Musk's SpaceX. So you'll notice the theme here. News was just coming in better than expected. Consumers kept spending even with gas prices elevated, and firings were still almost non-existent. At the end of the day, strong economies lead strong earnings, and earnings are what drive stocks over the long term, helping investors to dismiss the on-again, off-again headlines that shifted almost daily related to the Iranian conflict. But of course, there's a caveat. When you have strong economic growth, stable labor markets, and higher oil prices, you tend to create a recipe for inflationary concerns, and thus interest rates begin to react accordingly. That's also what we saw. In fact, if we go back to the spring, betting markets were still giving the US this year a 1 in 3 probability of a recession, which is pretty elevated, and that had investors forecasting the next move from the Federal Reserve to be a rate cut. However, new Fed Chair Kevin Warsh largely squashed that prospect, which I'm sure we're going to discuss more later, and recessionary odds are almost now non-existent. As such, most yields across the curve closed the quarter materially higher than where they started at the end of March. But as we've written about recently, high rates are not always indicative of a problem. Sometimes they're actually a symptom of something good. So we're going to cover a lot of this, I assume, in much more detail. But before we do, I want to give one quick reminder, and that's that last quarter was a very important relationship in terms of geopolitics and markets. When the market's fundamentals are aligned, supported by strong earnings and economic growth, which is what we saw, geopolitics really tend to create a lot more noise than trend. And that's a message that served First Command and its clients well over time. 2026 has just provided another reminder of the same. Now, we really just need to see corporate America continue to deliver on what have been pretty high expectations that have been set moving forward.
Yeah, and you hit on it there, but it's pretty amazing, even to me, just how quickly the market seemed to price in that Iran shock and shift focus back toward non-war concerns, which is a great segue to Mr. Murphy, who spends more time in the market trenches than anybody I know, or any of us. So, hey Dan, what's standing out to you?
Sure. Maybe I can pick up on a few points Matt just raised. First, briefly on the SpaceX offering. So this really was a historic IPO. The company raised more than $80 billion, which is roughly 3 times the size of the previous record for an equity capital raise. And at a current valuation of over $2 trillion, SpaceX now ranks among the 10 largest companies globally, alongside behemoths like Apple and Microsoft that have been around much longer. So, but more important than the scale, though, is really what the deal signals, which is that risk appetite remains intact. Investors are still willing to fund capital-intensive growth stories, even those with long and uncertain paths to profitability. So what does this mean looking ahead? Despite the conflict with Iran, investor confidence was already reasonably firm heading into the offering, with the S&P 500 rallying to all-time highs in May and early June before the IPO. So in this sense, the IPO really doesn't mark any sort of turning point in sentiment. To me, it's more about the absence of a negative. Had the stock really struggled coming out of the gate and fallen below its offering price, it could have raised concerns among investors and weighed on broader markets. But instead, the deal really held together, and that outcome reinforces a constructive backdrop for risk taking. But it doesn't, in my view, really impact the market's trajectory from here. Matt also mentioned the path to a memorandum of understanding with Iran, which was arguably the defining factor in global financial markets during the second quarter. There's this old adage that markets climb a wall of worry, and that dynamic was clearly on display. Markets sold off in March following the outbreak of the conflict, and this ultimately created a more favorable setup for returns in the months that followed. As tensions gradually eased and negotiations sort of moved forward in these fits and starts that we saw, investor focus shifted back to strong earnings and resilient economic data. This backdrop had several notable effects across global markets. The most immediate impact of easing tensions with Iran was the sharp decline in oil prices from over $100 per barrel at the end of March to around $70 today. Unsurprisingly, that weighed on energy stocks, which fell about 13% in a broader market that was up by 15% or so. So the improvement in geopolitical conditions also supported risk appetite, most notably in technology. That sector surged 32% in the quarter as capital continued to flow into companies leveraged to the AI theme. While technology was by far the strongest sector, other cyclical areas such as real estate, industrials, and financials also performed well. In contrast, defensive sectors like consumer staples and utilities lagged. This preference for risk extended beyond the U.S. borders too. Internationally, emerging markets outperformed, led by countries like Korea and Taiwan, where the equity indexes are heavily weighted toward technology. A similar sort of risk-on pattern emerged in fixed income, with the riskier segments like emerging market debt and high yield outperforming, with gains of roughly 4% and 2% respectively. Given the strength of both the broader market and technology in particular, one of the more surprising outcomes during the quarter was the relative underperformance of the so-called Magnificent Seven. This group of large tech-driven companies, including household names like Microsoft, Amazon, Alphabet, they did post gains for the quarter, but they lagged the overall market. That's a little counterintuitive since other companies with significant exposure to AI-related growth had much better returns in the quarter, and this really speaks to another theme Matt brought up, which is the broadening we're seeing in the market. Stock market leadership has become less concentrated, with gains extending beyond the largest mega cap names to a broader set of companies. To put this in perspective, the Magnificent Seven rose close to 130% over the course of 2023 and 2024, and this drove U.S. large cap equities to significantly outperform other areas of the global equity market, including international stocks and U.S. small caps. While the group delivered solid gains again in 2025, its performance was much more in line with the rest of the market. And so far in 2026, the shift has gone further. The Mag 7 are about flat on the year, even as most other segments of the global equity market are posting solid gains. Last year, there was genuine concern that the broader equity market had become overly dependent on this small group of mega cap companies. In 2026, that concern looks misplaced. The main driver behind this shift has been earnings. In 2022, corporate profits globally came under pressure as higher input costs and rising interest rates weighed on margins. but the Magnificent Seven rebounded very quickly. By 2024, their earnings were growing at a roughly 40% annual rate, helping drive double-digit profit gains for the S&P 500, even as earnings growth in international markets remained in sort of the mid-single digits range, and U.S. small caps were basically stagnant. Fast forward to 2026, and the earnings growth for the Magnificent Seven is still pretty strong, but it's slowed a bit. While the rest of the market has accelerated, U.S. small caps are now tracking around 12%. International markets are approaching the high teens, and emerging markets are growing even faster than that. So in short, profit growth is no longer narrowly concentrated. Corporate earnings are now strengthening across regions and sectors, and that is showing up in more broad-based gains in the global equity markets. Second quarter earnings are also tracking to be particularly strong, with S&P 500 profits up over 20% year on year, despite the war with Iran and the spike in oil prices. This is really a testament to the resilience of the economy. For instance, jobs growth has actually improved in recent months, with non-farm payrolls increasing by an average of nearly 190,000 jobs per month from March through May. That's a meaningful acceleration from the roughly 10,000 jobs per month we saw over the prior 12 months. This strength in turn has helped sustain the consumer. Real inflation-adjusted spending did flatten out in April as higher gasoline prices weighed on purchasing power, but that weakness proved temporary, and by May, real consumption was rebounding sharply. So despite the shock at the pump, the consumer has remained intact, supported by rising job growth, steady wage gains, and still healthy household balance sheets. Beyond the consumer, another key driver of resilience has been investment, particularly that tied to the AI build-out. Spending on data centers, semiconductors, electric grid infrastructure continues to grow at a rapid rate, providing a powerful tailwind to business spending. And this is likely contributing to the pickup in manufacturing that we are seeing. After a multi-year period of weakness, we began to see signs of life in the manufacturing sector earlier this year. That improvement is carried into the second quarter, suggesting that activity is gaining traction after a prolonged downturn. A lot of factors are likely contributing to this manufacturing renaissance. Some are more short-term in nature, like tax incentives in the One Big Beautiful Bill Act, and others are more structural, like reshoring to manage supply chain risk. Regardless of the cause, this is a welcome change for the economy. But stepping back, the broader point is clear. Even in the face of higher oil prices and geopolitical uncertainty, the U.S. economy has remained on solid footing. An expanding workforce is supporting consumers. Investment is strong, particularly in the area of AI, and cyclical sectors like manufacturing are beginning to improve. The combination has allowed the economy to absorb shocks far better than many expected. And it helps explain why markets have done well through a period of geopolitical adversity. While current trends are solid and the economic outlook is supportive of corporate earnings and stock prices, I think one wild card we're still wrestling with is the Fed and interest rates.
Which is a beautiful transition into our last major headline of the last few months. After 8 years as chairman of the Federal Reserve, Jerome Powell is out. Kevin Warsh is in. Now, for better or for worse, fairly or unfairly, the Fed chair is often seen as being at the helm of the economy. So any Fed chair change is a big story. But given that Warsh has been a long time outspoken critic of how the Fed conducts itself, this one promises to maybe be an even bigger shift. Now, there were some concerns about how Warsh would start his tenure after he was announced and during his confirmation, especially given that it seemed like he was selected for a single reason, which was to deliver rate cuts. And honestly, he did very little to push back on that idea during that process. We had inflation still running hot above target. Growth was strong. So obviously that raised a few eyebrows. But his first press conference seems to have put that idea to bed a bit, as Matt already talked about. More specifically, instead of the normal hemming and hawing about the Fed's dual mandate, which, while accurate, yeah, the Fed has to focus both on employment and inflation, the language from the Fed often left us wondering just how much it cared about employment or inflation at any particular meeting. Maybe how it was weighing the scales, as it were. Not so much with Warsh. His much shorter official statement, I think it was about a third the length of the previous ones under Powell, ended with a single line about the mandate, which is that the Fed will deliver price stability. Now, obviously, this doesn't mean that we have a single mandate like the European Central Bank, which is just price stability, just inflation. It just means that for now, as Dan just alluded to, the labor market's looking really strong. So the focus is kind of shifting almost not entirely, but generally onto the inflation problem. To be fair, this isn't much of a surprise. During his entire tenure at the Fed during the Great Financial Crisis, inflation was always Warsh's biggest concern. We just really didn't know which Warsh we were going to get when he came in. A Warsh that argued his way to rate cuts because of AI benefits or balance sheet tweaks or the inflation hawk. And now I guess time's going to tell whether this makes him just as unpopular with the White House that Powell was at the end of his tenure. The bond market, however, seemed to welcome it. Rate hike expectations surged after the meeting, given this very strong anti-inflation sentiment. But the 10 years actually moved down since the meeting. Yes, some of that was falling oil prices and very near-term inflation worries, but a lot of it was also falling inflation expectations, which are mostly driven by how the market perceives the stance of policy. And that Warsh line about price stability sent a very clear message, and it seems like the bond market took it seriously. There's one caveat, though. I should say we think we know which Warsh we're going to get, because the other highlight of that first meeting was Warsh's aversion to what we call forward guidance, which is generally used to describe how the Fed forecasts how it's likely to adjust policy in the future. In the formal statement it puts out after each meeting, in the press conference after each meeting, in the summary of economic projections that have those very famous or infamous dot plots. Warsh is not a fan, and perhaps for a good reason, because you could argue that many of the Fed's problems in recent years, especially after the pandemic, was the tendency to put itself in a corner by overcommitting to future rate decisions, whether it was talking about how long rates were going to stay at current levels or whether or not more hikes were appropriate. The result was often the same. The Fed hemmed itself in. If markets see these forecasts as the Fed's actual plans as opposed to highly conditional statements that are going to shift quite a lot as new data pours in, any deviation from them could be expected maybe cause a bit of a market overreaction, and maybe worse in the Fed's eyes is a hit to public confidence in the Fed itself. In essence, the idea we always talk about the Fed falling behind the curve, which just means it waits too long to act, it's late to the game essentially, may have just as much to do with how the Fed communicates as it does with the fact that they just have to deal with a lot of complicated data. So the Fed's still going to make mistakes. Obviously, economics are very complex and a lot of that's human error. But if we can avoid some unforced errors by signaling maybe a little bit less, that could be a win for the Fed. And obviously the changes don't stop there. We have a handful of new task forces that are going to examine everything from how the Fed measures inflation to its balance sheet to even how AI is going to impact the economy. And I think there's 5 of them in total. And we kind of have to wait a while and see how that's going to impact Fed policy at the end of the process. But one thing's for sure, which is it's going to be interesting to see how the Warsh Fed develops over the next few years. And with that, I think we can wrap up this quarter's update. As a reminder, make sure to check out our regular written commentary, including our monthly market musings, which you can find on our social media accounts, or you can get directly from your advisor, and also our catalog of articles on the First Command website. And as always, thanks for joining us, and we hope to see you right back here next time.